Whereas people who have the majority of their wealth and income actually from working or running a business, yeah, they pay way more than their fair share, I would argue. Anyway. Welcome back to another episode of Christian Financial Perspectives. My name is Sean Peters. I'm joined today by Bob Barber, my co-host, father-in-law, and the one who usually writes the overall outline for these episodes. So if they turn out great, you're welcome to leave a comment in there thanking me for it. If they're not great, then, well, Bob, you're the one that wrote it. So
today's, is always a good one we do because we're going to be doing annual year-end tax strategies.
Yeah, and believe it or not, Bob does have to update this each year because
every year.
The IRS does try to earn their keep to an extent, and they like to make changes every now and then. And of course, then you've got Congress that will make changes sometimes. Yep. So this is, I would love it if we could just kind of repeat this each year for our listeners and viewers, but nope, gotta go through all of them, make sure they're correct and up to date, especially for tax stuff. So our tax strategies for year end of 2025. And Bob, what do you want to start us out with on this?
Well, I want to first say, if you're interested in saving, possibly $1,000, $2,000, or $3,000 in taxes, this might be very valuable information for you in the next 12 to 15 minutes.
Yeah.
These are year-end strategies that we're going to give. So we always do this in December, but you've got to do these before the end of the year. If you wait, you cannot do the ones that we're going to give today in January. Right. They have to be done. And Sean, the number one reason for financial problems is procrastination.
It's not having a high enough return. I'm just kidding. Yeah, procrastination. I understand.
And people just procrastinate. But this is something you cannot procrastinate on if you want to save some money on taxes. And we're going to give some of these. You don't even have to worry about your itemized deductions because it just comes under the realm of right off the top of your income. And this year,
the key is the strategies that we're going to be covering today. Make sure that if you're going to take advantage of them, that you complete it by December 31st. And in some cases, depending on what it is, there's a little bit of a leeway even with that because obviously we've got Christmas, there's New Year's, custodians get busy. So I would probably say target getting this done by around December 15th, December 20th at the latest. Yeah. Just in case, because then once you roll into that new year, you may not have filed your taxes, but it's too late to do some of these strategies.
We've had those phone calls on December 31st. Sorry, it's just not enough time to do it. I think there's a good scripture that goes with this, Sean, and you're my scripture reader. So,
all right, let me put on my reading voice. Romans 13, 6 through 7. This is also why you pay taxes. For the authorities are God's servants who give their full time to governing. Give to everyone what you owe them. If you owe taxes, pay taxes. If revenue, then revenue. If respect, then respect. If honor, then honor. That's a great one.
This Romans 13, that chapter of Romans 13 talks about how we are to submit to the governing authorities. Yeah. You think about it, and the 10 Commandments was put in place for a government. Yep. And government is not bad, except when it becomes like communism,
Yeah. But we'll have to save that for another episode.
Yeah, exactly. But government is put in there to run a society with wisdom and where it's not chaotic, where it's calm.
Yeah. One day we'll have what do you call it? I believe it's the theocracy, right? So that would be like Jesus literally reigning from earth. Which will be great. Yeah. Well, ultimately, we know he'll always make the right decisions. But
he will, and hopefully freedom, free enterprise.
Yeah, we got to do the best we can with what we got for now. Yeah.
The one thing before we discuss any of these strategies, and we're going to discuss, I think 6 or 7 of them, the main thing is that you understand the standard deduction, which this year is interesting with the Trump's, he calls it the big, beautiful tax bill, isn't it?
Yeah.
He's always coming up with
big and beautiful. And,
I know it.
And better and great.
Yep. But the standard deduction for 2025 for a single person is $15,750. That means that's your standard deduction right off the top. Yeah. So your itemized deduction's got a total more than that
for it to be worth it.
And one of the things I always want to mention with this, and Don, our CPA, and Mariah's a CPA too that works with us, very important that he said this, make sure that everybody understands that tax planning should be done in multi-year increments. especially with the standard deduction so high. Because for a married couple, for 2025, that standard deduction is $31,500. And the big, beautiful tax bill added this much more for seniors. If you're both above 65 and married, that standard deduction can go up over $46,000.
Wow.
Yeah.
46,700 to be exact.
46,700 is the max. It can go as high as that. If both seniors are not 65, it won't go that high. It'll go to about 40. But if both seniors are over 65, it can go to 46,700.
Now, I do see you got some notes on here that the additional bonuses for seniors does phase out with higher incomes. So
Right.
it depends on how much you're making.
And I can tell you what that is. That's around $150,000.
Great.
So if a senior makes over $150,000, it starts phasing out.
Yeah.
You know, Sean, I put this on the tax tables that somebody that makes $150,000 or under, and say that about $60,000 of that is Social Security for both the husband and wife.
Yeah.
50 to 60. You know what? Their effective tax rate's only 3%.
Wow.
Yeah.
Hey, that's great. That's
really
great news
low.
for seniors.
Yeah.
Yeah.
Yep.
Can we see if our government can get that at least maybe under 10% for the rest of us?
Yeah, it would be nice. It would be nice. Mine's at about 35%. So I guess they'll say, well, Bob, you'll pay it. You know, guys like you, the wealthy don't pay their fair share. And even though you've been an entrepreneur for over 40 years.
Yeah. Well, remember, Bob, that whole
Yeah.
fallacy comes from, you've got people that are super, super wealthy. They're like billionaires, and people think they just have, billions of dollars sitting in cash in their bank account. Like, well, no, it's from assets and things that they'd have to sell to get any of the money.
Right.
Whereas people who have the majority of their wealth and income actually from working or running a business, yeah, they pay way more than their fair share, I would argue. Anyway.
All right, so let's go.
All right, number
we
one.
gotta get through these. There's a lot of these to get through.
Yeah. Stop talking so much, Bob. Year-end tax strategy number 1. Max out contributions to company qualified plans.
That's right. So if you're under 50, that's $23,500. Or if you're over 50, it's $31,000. And then there's this weird thing between 60 and 63 years old. You can go up to $34,750.
Yeah,
I don't know who comes up with these
the
numbers.
super catch-up provision.
Yeah, it's called the super catch-up provision. It's exactly right.
So if you didn't hear that the first time, 60 to 63, there's a special super catch-up provision that goes from, instead of $31,000, it's $34,750.
So you realize if you're putting money in your 401k, and let's say you've put $20,000 in there, if there's somehow, some way before the end of this month, you can add another $14,000 to that, that's going to save you a lot in taxes, because that comes right off your income.
And
that's
again,
the
just
most important thing.
to clarify, this is to the pre-tax or your traditional, not the Roth that many of the plans have, like a Roth option where you're paying the taxes now. So make sure if you're trying to take advantage of this, it's for the pre-tax portion. So that way it reduces your total taxable income.
Most people I know, they're not putting that much money in a 401k. They may be putting $10,000 a year. They didn't realize they could go that high. Again, if you're under 50, $23,500. If you're over 50, basically $31,000. That's a lot of pre-tax dollars, and that's before your match.
Exactly. Yeah. So that's again not including what the company is contributing, and that would be kind of the, I guess, pro tip on this one. Make sure whatever your company matches, that dollar for dollar, or sometimes it's maybe 3% match 100%, and then the next 3% they match 50%. Well, in that case, make sure you're putting 6% away.
Yeah.
To make sure you're not leaving money on the table that the company is already going to contribute. So no matter how the underlying investments do, you're getting extra money.
Yeah.
All right, year-end tax strategy number 2, max out charitable contributions.
Now, our next program that we're going to do in just a couple of weeks from now is going to be on the Donor Advised Fund, which is a really great vehicle that you
is
can
a great
use.
one.
But you got to remember with this, it's called the 30-50-60 rule.
Okay.
And that means you can give 30% of your income to charities, but that would
Your
be
adjusted gross income.
your adjusted gross income, but that's in non-tax. Like
Got
if you
it.
want to
Okay.
give a car away.
Or non-cash assets.
Yeah, exactly.
Stocks, land, cars,
Right.
other valuables.
But the cash, you can give up to 50 to 60% of your income. Most people don't do that, but there's that option there if you wanted to give that to charities. You can do that before the end of the year. And we're going to mention a donor advised fund, like I said, on our next program, which is something you can plug in a lot of money to right before the end of the year. Get the tax deduction. And then there's no pressure when that actually goes to the charities. Like, let's say you don't know, I want to do that, but I don't know what charities I want to give to.
Gotcha.
Donor Advised Fund, we're going to get in all the rules on our next program. about that. It is an excellent vehicle. I've been using it myself for many years. Last year, I did a huge donation of some stock that appreciated.
Yeah.
And I didn't have to pay any tax on that
So
appreciated
you
stock
can
either.
basically the reason you do that is because then you can meet your tax and giving goals
Right.
by the end of the year for the before the deadline, even if you haven't identified the specific charity or charities that you're going to send it to, because you can't take it back once it goes into the donor advice fund.
That's exactly right.
Yeah, that's a great one.
All right.
Year-end tax strategy number 3.
Yep.
Max out property taxes in this year, especially with the big, beautiful tax bill.
How to get over that big, beautiful tax bill thing is so funny. But remember, when you're paying your property taxes, and I emphasize again, it needs to be thought about in multi-year increments.
Right.
Because
Okay.
you want to load up on your property taxes in 1 year. But this year, it's gone from $10,000 to $40,000. So let's say you have, like here in Texas, our property taxes are just outrageous. I think everybody knows about that.
But we don't have the state income tax, so
That's
just
true.
a balance.
That's true. But I think
yeah,
a
it
lot
is
of
high.
people that moved here from California, they're being very surprised. Like, oh my goodness, I get this property tax bill, which can be on a $500,000 house, can be as much as $10,000 a year here in Texas. But let's say you had a second home here in Texas or somewhere else, and that totaled $20,000
Right.
in
Okay.
tax. Well, you can now deduct that.
Because of the
Before, you could only
40,000.
deduct up to 10.
Right. So you could deduct, or you could pay and therefore deduct the property taxes from next year and this year if you do it all now.
Right.
Like, so from what you paid earlier in the year, then you got your tax bill, so pay it before the end of the year. Now you can deduct
That's where you
that
double
up
up,
to
because
40,000.
remember, you want your itemized deductions to go over
Right.
the standard deduction, which is very hard for a lot of people to do now
Yeah.
because it's so high. Okay.
All right. Anything else on that one?
Nope. Let's go to
All
the
right.
next one.
Year-end tax strategy number 4, tax loss harvesting.
We do this a lot around here. This has to do where you look at your holdings, like your stock holdings, and you say, well, what's appreciated versus is there any that have gone down in value? Because not everything goes up. And you can sell your losers against your winners.
Yep.
And that's called tax loss harvesting. Now, the one thing about it, there's a rule in here. It's called the wash rule. And if you do this without a financial advisor helping you or a CPA, you got to realize you cannot go back in and buy that particular holding for 31 days.
Right.
Or a like kind holding. You got to be very careful with this. And the IRS is looking at these rules.
Yep. So you got to make sure you move into something else for that 30 days. But we typically say, like, okay, just plan on purchasing it at least 31 days later.
Right.
To make sure you don't run into that.
This is for people that want the holding, but they're just like, I'm just doing this for the tax purposes.
Exactly.
It's called, like you say, it's called tax loss harvesting. That's that it's actually called that. You can look it up. All right.
All right. Year-end tax strategy number 5, make gifts to responsible children, grandchildren, or anyone else.
You notice I said the word in there.
Responsible. I saw that. Yeah.
Yep. So if you have a fiscally responsible child or grandchild or someone you want to give money to, you can give up to $19,000 per person, or a married couple. Like if we wanted to give $38,000 to Ronan this year.
Okay. Yeah.
He's kind of young to be doing
parents.
that with.
I feel like
or his parents. Okay.
are pretty financially rescible. So
Rachel
I'm
and I
not
could
gonna
do
say
that
no.
as a married couple. We could give away up to 38. You could receive that, and it wouldn't be taxable to you.
Great.
Okay, up to 38. You start going over that number.
Put that in the continuing education fund for the kids.
You know, we have to talk about that.
You know, Bob, I think I can speak for Jenna on this. My your oldest, prettiest, smartest daughter. I'm not biased at all. But if you guys wanted to do that to help you with your tax issues, like, we'd make that sacrifice. I'd be okay.
Sounds
with that.
good. Sounds good. All right, let's get down to
Number 6.
Number 6.
Year-end tax strategy number 6, income timing.
Yeah, this is a good one for those of you that might be thinking about retiring next year. And maybe if you have a bonus that's coming at the end of the year, ask your HR department if you can delay that bonus until next year.
Okay.
What's happening is you're layering that on top of a higher tax bracket.
Right.
Because the tax brackets go up in increments.
So, for example, you're retiring at the end of this year, and you have this bonus coming. So, would they be willing to issue that bonus towards the end of January?
Yeah,
or something.
That's right.
Right. Okay.
Yeah, that is a very good one. It's always something good to do Also, if you think, you may not be getting that bonus next year, maybe half this year and half next year. Okay.
Okay.
That's what I mean by income timing.
Yeah.
And then we're down to our last one.
Yeah. Year-end tax strategy number 7, buy business equipment before December 31st.
A lot of people have a part-time business.
Yeah.
And they may work out of their home. It's time to go buy that computer that you need to update.
Yeah.
Or maybe you need to buy a new desk. But this kind of stuff is
or
tax
like if you're
deductible.
in construction or some of the other things. Like I know for my dad with the mining and excavation and farmland stuff, like, well, maybe grab some new tires, or maybe go ahead and buy that new service truck or something because you can get it in before the end of the year.
This was big for you growing up because your dad's a farmer.
Yeah, and with the excavation and mining, there was always seemed to be a surplus of tires towards the end of the year because you're going to need them anyway.
Or a business vehicle, you could do that.
Yep.
And the big sales, always come around December 31st. They're in the panic to make their year-end quota.
Exactly.
So it may be a good time.
That business vehicle, you go towards the end of the year and they'll work with you.
Yep, exactly.
All right. Well, that wraps up all 7. These are, of course, there are many more year-end tax strategies, but we didn't want y'all to stick around for an hour. So we're just going to
want them to have to stick around for an hour.
Yeah. Oh, we'd love for you to stick around.
I think they might go to sleep because these tax strategies can be boring.
Yeah. All right. Well, hopefully, though, you can save thousands of dollars in taxes for 2025 by using one or more of these year-end tax strategies. But remember, all these strategies we mentioned today are ones that must be done by December 31st. So time is of the essence. Don't procrastinate on these.
And contact your CPA, your accountant, or your financial tax professional for any of these before doing them.
Because there may be some other particular things that you're working with them on that, I don't know. I mean, I'm not saying that any of these are bad, but there might be something that could impact or be affected by some other strategies you're utilizing.
And it's the third time we're just going to say this. Tax planning always should be done in multi-year increments now because of the standard deduction so high. If you want some help with this, feel free to give us a call at 830-609-6986. You can also text that number, 830-609-6986. Or you can go to our website at christianfinancialadvisors.com and you can contact us through our website.
Feel free to also comment, like, all those good things, depending on where you're watching or listening to this. And until next time, God bless, and we look forward to seeing you again. Thank you for watching. If you want to see more videos just like this, make sure to subscribe, turn on notifications, and like this video. If you have questions, you can visit our website, call, text us, or comment below. See you next time.